So good evening. This is Ken Long from Tortoise Capital with review of the weekend trading report for July 7th, 2013. We have a market that is in bullish volatile conditions on an annual basis using weekly RSI 14. We're in the high end of neutral at 6,100. On a 10-day basis using the 10-day NDX, we are overbought at 106 out of 100, meaning that it closed at a new 10-day high compared to the previous 10 days. So it was 6% higher previous 10-day trading range. Let me say it again. If you took the previous 10-day trading range and then took 6% of that, that's how high Friday's close was compared to the previous 10 days. That's what I'm trying to say. Look at the market mosaic indicators. Percent stretch relative to the 200-day moving average is 8.59%. So we're about 6.5% above sideways channel of the sideways condition. The slope of the 50-day moving average improved slightly to 0.35%, which is yellow neutral. ADX is still hovering around 20, or non-trending at 19.5. ATR percentage has declined to about 1.38%. It's still volatile, but it's getting less volatile. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, is at 0.99. That's it's 0.01, just below the boundary to risk off. That 0.99 value has a risk z-score of minus 2.3, so it's minus 2.3 standard deviations below the 5,000-day average. You can see here that a 90-day time series of that risk index, and you can see it had this double bottom down here by minus 1.5, and then over the last 10 days volatility has been beginning to dry up, and we were just about back to the line. In the blended monthly rebalancing, the 32 ETF portfolio holds financials, healthcare, and consumer discretionary among the U.S. sector fighters. The 13 ETF portfolio is holding Japan, U.S. small caps, and the Dow 30 industrials. The next reevaluation is for about 1 August. ETF2, the theoretical exposure is at 50%. The model portfolio itself is at 6% exposed with an update to stops. And here's a YouTube channel with some trading videos that were uploaded this week. And moving on. Quick look at the blended monthly rebalancings. The 13 ETF portfolio, the current winners are Japan, small caps, mid caps, then large caps. So it's still U.S. heavy. Among the 32 ETF portfolio, discretionary, financial, selects, spiders, and Japan. So Japan has a little resurgence there. But primarily U.S. Among the top end. That's fine. It's the internet connection. Next up is the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance levels in the past. The horizontal red lines are support levels that have held in the past, and they would represent price targets if we have market weakness. We would be looking at those as targets on the downside. Right now, the recent swing high at 167.5, based on the 2-period Bollinger Band, this ribbon high back here in May, is still holding. We need to see price, Lisa, yes. The recent swing high at 167.5 is, I need to see price above that before we could be convinced the bull has resumed longer term. We've had a nice rebound here in the last 10 days. We've had a nice rebound in the last 10 days, but we're still only about halfway back up to the Bollinger Band median at 162.5. The river is the dotted blue area in the middle, which is a 30-period Bollinger Band plus or minus 1 standard deviation. The lighter blue shade area is 2 plus or minus 2 standard deviations, the floodplain. So what we've seen here in the last 10 days is a market that price came out of the floodplain to the downside, found support at 157, made a regression line crossover, has fought its way back to the middle of the river. And now we're still in the middle of a tactical trade here between 167.5 at the top of the floodplain and about 157 at the bottom of the floodplain. And we're still in the middle of the river. The slope of the river is down, but you can see price has made it back into the river. The slope of the regression line, which is a thin black line, you can see has now improved. It's still negative, but it has turned the corner. At the same time, the oversold conditions from 10 days ago have now become overbought conditions. That's the basis for the channeling and the overreaction system rule set. There was a nice trade in here in those systems. Thick black line in the middle is the 30-period regression line with a 1-day lag. The outer black lines are the channel formed by the maximum excursion from the regression line during the look-back period. That sort of sets the boundaries of normal in the RAF regression channel strategy, or the indicator, if you will. We're about 3/4 of the way towards the top of that channel, and that coincides right now with the top of the river, which is really a reasonable price target from this oversold condition. That's actually about as far as you could reasonably expect it would move, and still maintain this slightly downward bearish pressure of the last 30 days. So this is a natural place right around 164 for it to find resistance and resume the downward trend. So we'll be looking very carefully at whether or not price is going to be able to get out of the river, which coincides nicely with these last two support levels. The percent price oscillator has opened its jaws to the upside and has been looking favorable for the last 3 or 4 days. So Friday's price action is encouraging to the long side, but again, we want to see it get through 164 and then 167.5 before we are bullish once more. So right now, I'm looking at this strictly as a tactical trading opportunity, and I'm ready to go with the market. Either I have a slightly downward bias. I'm willing to take the downward trades quickly because of the downward slope of the river. Next up is a daily chart. About 6 months back, I wanted to take a look at the regression line crossover framework as applied to the market health check. Let that come up on your screen. There we go. All right, looking at the regression line crossover framework, you should be able to identify what's going on in each one of these different circles. What I'm showing here on the blue line at 167.30 is the boundary to the true bullish move. In other words, taking out the previous swing high here at 167.30. That also happens to be a price target in the purple circle. I use purple as price targets. So that shows the region where at the top of the floodplain would be the secondary objective on the current price action. The first one is at the top of the river, which coincides with this green 90-period regression line. The blue circle, blue generally means decision point for me, or an action signal, or an important state, a destination, if you will. And this is price has now, and the ribbon itself have moved to the Bollinger Band mean, which is that middle red line. And this is a natural decision point. It's either going to continue on to the top of the river and to the floodplain, or it reaches here to continue this downward pressure that we see based off the slope, downward slope of the river. The southernmost circle here is the extent of the price ribbon. That's the 2-period Bollinger Band. That's as far out of the river as it got. That also is looks like a bottoming tail, which is a large range bar or candle that has most of its price in the upper half. It has the real body, if you will, in the upper half, has a long spiky tail. That's also what Kim Anderson looks for in the Anderson regression line stretch, and that is something that has moved sharply away from Bollinger Bands and then has started to reverse. And you see right after the price end of the river is where the 10-period regression line started to reverse at the edge of the floodplain in that green circle. You see the regression line crossover occurs a couple days later, right around the time the price re-enters the river. So in my view, there are opportunities to enter this on a swing basis from when the price ribbon left the floodplain and then re-enters the floodplain. I call that the Z swing, in which case the Z score is less than -2. In other words, it went more than 2 deviations away from the mean, and then reverses to cross back over the -2 level, which is the boundary of the regression line here, or the boundary of the floodplain. That's when I like to enter on this one with a stop below the ribbon. And then what I'm looking at for price points are return to the river and then to the Bollinger Band mean, and I play that as a 2-to-1 reward to risk ratio. So that's what's going on here. We've had a series of 2 lower lows, at least 2 lower highs as well. The river has rolled over. The 90-period regression line has rolled over. Still volatile conditions, and we've had a nice price move all the way back to the mean. That doesn't make me bullish. It makes me absolutely neutral with respect to preference for direction from here on. I still think this is a trader's market. We're equidistant to resistance at the swing high at 167 and the bottom of the floodplain as a price target at 157, and that puts us right in the middle here at the Bollinger Band means. I am absolutely direction neutral, and I'm prepared to go either way on the intraday trades. Longer term, still bullish, but that is beginning to decay, as you can tell by the 90-period regression line is rolled over, and the 30-period regression line is out of the river, and the river itself is rolled over. So this is no reason for optimism at this point. Moving on, the world market model, or the ETF2 summary, 5 out of the 10 sectors are on buy signals with price compared to the moving average filter, and that keeps us right at 50% invested, 50% cash in the theoretical model. The actual ETF2 is at 60% because it had more positions and those stops haven't been hit yet. Right now, the S&P, the U.S., is better than the globals, which are represented by EFA. So 55 in the strength column is better than 48 for EFA. So we can say the U.S. is still stronger than the globals. Inside the U.S., the small caps and mid caps have now resumed their leadership position over the S&P and technology. So you can look at that as a return to risk-on conditions in the U.S. This is money looking to be a little more aggressive, and the small caps and mid caps are natural targets for that. The 2 strongest sectors are IWM at 58 and Japan at 57. And the 2 weakest remain Latin America at 30 and emerging markets at 36. So that you read EM, but only EPP is pretty weak too. Looking at the sector spiders, the 3 strongest in the looking at financials, Healthcare and consumer discretionary strong across the board. Industrials are getting better, not bad here, 55. And let's see, 7 out of 9 are now on a buy signal, whereas last week this was only 4. So we're seeing some broad improvements in the U.S. Based on that market recovery of the past 5 days. Looking at the world market model next. Small caps across the board are exceptionally strong in the green. The rest of the U.S. Is all above average. Japan remains above average. China is exceptionally strong at 59. Only Malaysia and Taiwan are above average in the Asia less Japan sectors and countries. Latin America, emerging markets, Mexico and Brazil, all well below average. Canada in the yellow. All of Europe is above average. The weak countries are Sweden, Austria, and Spain. Taking a look at the global business sectors, in every case except utilities, the U.S. Is better or tied with its global counterpart. Materials are tied, otherwise it's decisive advantage U.S. Consumer discretionary and finance are strong across the board. Weakness in the defensive sector like utilities. Top 30 ETFs, little change from last week. Solar and clean energy remain at the top. Lots of banks and biotech, financial services you can see in there. Retail is still remarkably strong here, the S&P Retail XRT. You can see consumer discretionary XLY and financials XLF are in the top 30 of opportunities around the world. And then you see the strength in the small caps here with growth, the broad index, and the value index. It's small caps. That's a sign of index buying. And you can see that they are green on strength and white on consistency. This is a relative new phenomenon. This is a return to risk on. Also, you got the Internet Index and the Russell Growth Index over here, so that's small caps. Vanguard small cap growth. High beta portfolio from the S&P, another small cap, Russell 2000, Vanguard small cap. This is really the re-emergence of U.S. small caps. That's the first strength, the first sign of strength we've seen from them really in almost 10 weeks. They've been lagging large caps for over months. So that could signify a sea change back towards risk on. I would take that seriously. Inside the Dow 30 is up next, using the same lens. The weakest three remain Alcoa, Caterpillar, IBM. Now they're joined in the yellow by AT&T. AT&T is relatively newcomer to this weak area. As you can see, its consistency rating is in the white, but its relative strength in the yellow. So that's a sign of declining strength. In the same way, Bank of America and Verizon are green on consistency, but white on strength. That's a bad sign for them. Hewlett-Packard, Boeing, Microsoft, American Express, and Cisco remain the key leaders. Hewlett-Packard has moved all the way up to 25.5 now. So leader to lead. We're going to shift to the daily report now. I'm not going to read the top row, but no signals of a reaction channeling. You can see the strength here in the 10-day NDX time series, how it's been improving steadily over the last 10 days. You see the volatility has rolled over at about 2 standard deviations above the over the 100-day average. Is now returning back to lower levels. ADX, it's still a dogfight here in terms of trendiness. Between bulls and bears, that the difference between starting to recede, that's actually a bullish sign because bears had been in charge here because of that less sharp sell about 15 days ago. No pattern trades. However, we have a ton of quality setups on the auto framer. These are all that test out better than 2 to 1 on a reward to risk ratio using mechanical entries. 10-day Max Pains, Pfizer, Alcoa, IBM, Intel, Caterpillar. 10-day min pain, these are the ones that are the closest on a percent basis to their 10-day high. United Tech, JP Morgan, 3M, ExxonMobil, and Home Depot. Move on to tactical summaries. First up is the Dow Tactical Summary. No patterns. There's one doji here in Intel. You've only got two that test out on the auto framer. That's Pfizer and IBM. Nothing signals on the RSI2, so this has been a broad-based market move the last 5 days. Lots of quality frog candidates here. Cisco at a 3.9 is kind of remarkable. AT&T at 3.8. The max pain range compressions, these are my favorites, by the way. Pfizer and IBM test out better than 2-to-1, and they're all good frog quality candidates. So I think there's reason to be interested in them for winners on Friday: American Express, Bank of America, JP Morgan. Does it sound like financials to you? It should. Losers: Cisco, Procter & Gamble, Coke, and McDonald's. But even the losers didn't really lose that much. In fact, Coca-Cola was an exceptional laggard on Friday, and it was up 0.1%. 3M and the others all doubled, almost been 2% gains on Friday. So if you're looking for continuation, financials would be an interesting play. Among the ETFs, using the same lens, we have 5 that test out on the RSI2. There's signal on the RSI2. The VIX, Brazil, 20-year treasuries, Latin America, and utilities. XIV, the inverse of the VIX, was the big winner on Friday with a 5% gain. Not as many frog candidates, although there are some. And all 5, the top 5 max pain range compressions test out better than 2-to-1 on the auto framer. So I would just Brazil is an interesting one to look at. Being a 5-day down, tests out a 2-to-1 on the auto framer, is 3.1 on the frog, and has an RSI2 value of 3. That's like a 2-day washout, and it should respond to broad-based market strength if that's what we see, and I wouldn't be surprised to see lots of catching up there. Now, what you notice on XIV is that when the risk index made its double bottom at -1.5 standard deviations 10 days ago, since that time, XIV has moved 12% in our favor, and so I tend to pay attention when we have extreme moves in volatility on the risk index outside of ±1 that reverse, because that tends to be a very smooth curve, and that signifies a change in the volatility regime, if you will, and so that's been a reasonably good trade for us. The last chart I'm going to show today is the auto framer, and let's see. So these are all symbols that test out better than 2-to-1 on the reward to risk ratio. Gold, VIX, silver, Pfizer, Treasuries, IBM, coal, and Brazil. And the framing data basically shows you where the mechanical entry, the mechanical stop, and then the price target of a test of the 10-day high would be. Computes that into dollars, and then there's multiples of ATR if that's what you prefer. And in every case so far, it compares 3 levels of risk: the minimum ATR risk of 1/4 of an ATR, maximum ATR risk of 1 ATR, and then the range risk, which is getting a stop 5 cents below yesterday's low and an entry 5 cents above yesterday's high. So range risk is really yesterday's range plus a 10-cent buffer, because I'm using that nickel for confirmation on either end. And this column here, or this section under risk calcs, finds the middle value of risk between minimum ATR, maximum ATR, and range risk, find the middle value and uses that as my risk, and then use that as the risk value for computing reward to risk. So those are the ones that for me are high priority trading targets because of their trade location inside the swing trade time frame over the last 10 days. So it's not a pattern trade, but it is it's based on pure reward to risk using a standard lens. Okay, so we're about half an hour into it. That's everything I wanted to highlight. Again, I think we have a perfect market for technical trading. I'm ready to start with these auto frame candidates and waiting to see what direction the market shakes out. In either direction, there's a lot of quality frog candidates. That's a good way to get started when you're in tactical trading time, and you want to just let the market choose instead of trying to interpret it, reason out what's going to do. Just use the frog number as a way to respond to the relative volatility of the recent market, and then become directional once the day starts to unfold. But because where we are, we've had a sell-off to more than 2 standard deviations below the mean, and it fought its way all the way back up over the last 10 days. That's a natural place for tactical traders to preserve their profits rather than look for more. And so I believe you can make an equally strong argument for trading either direction on a swing basis, and that's why I'll dial down to intraday to get well started and simply respond to the direction the market takes. So we're still in bullish volatile. There's been a nice pullback, but a reasonable bounce has already occurred, and we have to get through 167 for me to be convinced that this is really a return to the bull. So I'm cautiously optimistic, but I'm ready to go in either direction. I have my price targets marked out in both directions, so I am agnostic with respect to direction. I'll stick around for a few minutes if there's any questions, but other than that, that's what I have for you tonight. I'll process video and get it uploaded on YouTube in an hour and a half.